get started. So we were seeing yesterday, we finished by looking at the full consolidation method. Okay, so here this was our last example where the parent company buys 100% of the shares of the subsidiary for 150, which was the book value, so the value of equity. And then in this full consolidation procedure, in the first step, we set up the combined balance sheet where we add up all the assets, liabilities, revenues, and expenses in the income statement for all the companies in the group. And then we eliminate group internal transactions in the combined balance sheet. So the minimum will always be the investment in the subsidiary and the equity provided by the parent company at the date of acquisition. That's important. We do not eliminate the current equity of the subsidiary, but the equity at the date of acquisition. And then, while we are done, the remaining assets and liabilities constitute the consolidated balance sheet. Okay. So let's have a look at the exercise number 1 for that matter. Let me make this a little bit bigger. Here we go. Exercise number 1. Okay, so here on April 1st, that's the acquisition date, April 1st of N, we have the two individual balance sheets of PC, the parent company, with different assets and liabilities, and of the subsidiary S with some assets and liabilities. Here we have the balance sheet of PC before the acquisition. That's why we still have a big cash position. We did not yet invest in the company. So maybe let's get started with the B part. Okay. And then after that, we do the A part. So in the B part, prepare the consolidated balance sheet on April 1st, the date of acquisition, assuming that the parent company acquired 100% of the subsidiary S shares for 160. So here my first comment is, okay, we prepare here balance sheet as of April 1st, but that is only for, let's say, pedagogical purposes. In real life, we would not prepare a balance sheet or consolidated financial statements on April 1st. We would prepare them, well, not at the acquisition date anyway. We would prepare them when it is mandatory to prepare them, which means at the end of the year, maybe at the end of the quarter, if quarterly reporting is required in the country where the parent company is located. So again, usually we do not do a consolidation at the date of acquisition, but at the official financial statement dates. Okay, that's my first comment. And secondly, a question. So here we see the parent company spends 160 to buy all the shares of the subsidiary. Okay. Why does the parent company pay 160? So not 150, not 170, but precisely 160. Well, I asked you already the same question yesterday, so but still let's repeat it. So why do we pay 160 here to buy all the shares of the subsidiary? Anyone? Here we go. Indeed, Kantran, that's very good, because the total equity of S is 160. Equity is capital, but also net income. So it means also here we do the acquisition at book value, okay, because we just pay the price that corresponds to the equity at the date of acquisition. Okay, so then let's do the consolidation. Before we do this, we have for the parent company here, we have to account for the acquisition, okay? Because what will happen? Well, the parent company actually spends 160, so there will be a cash outflow. And as a counterpart, the parent company will acquire the investment in S or the shares of S, and they will be accounted for at their purchase price, which is 160. So that means my cash position after the acquisition obviously is 0, and instead I have an investment in the subsidiary. Okay, so this is my balance sheet before we go into the consolidation. And now what we do is actually, well, I can take this balance sheet here, copy it. Sorry, let's do this and put it here. So we set up a combined balance sheet in which I will add all the values that I have. So here I have already the numbers of the parent company. They are already there, but now I will add all the numbers of the subsidiary. Okay, so parent equipment is 240, subsidiary equipment is 200. So that means in total I have 440 of equipment. I have no cash, I have the investment. Okay, so that means we have in the combined balance sheet total assets of 600. In liabilities, I have the capital of the parent company plus capital of the subsidiary. Net income, I have net income of the parent company plus net income of the subsidiary. So it's just line by line addition. And I have liabilities of the parent company plus liabilities of the subsidiary. Okay, which means here I have all these final values, and obviously my combined balance sheet is also balanced. Okay, so I just add up all the numbers line by line, and then we need to eliminate what is group internal. Okay, so delete it. Well, here I have something that is group internal, which is the investment. And therefore, let me see where I can do this. I will delete this, the investment, and I need to eliminate the equity of the subsidiary at the acquisition date. That means here I will delete the capital of 100, and I will also delete the net income of 100. Both of these items will be deleted. So that means I delete 160 on the asset side, I delete 160 on the equity and liability side. So that means we are balanced. And since we have no indication of any other internal transaction, we are already done. That means my final assets is 440. My final capital is 300. My final profit is 20. Total liabilities is 120. That means I have total equity and liabilities of 440. Okay, and that would be my consolidated balance sheet in the end. Today after the class, I will put on Canvas the solutions to the exercise. So you will have the paper version of all the solutions here. Okay, what can we observe in this consolidated balance sheet? At the date of acquisition, for example, the equity is only the equity of the parent company, okay, because equity of the subsidiary is eliminated. And also very important, the profit that existed at the acquisition date made by the subsidiary does not count as a consolidated profit, because the 60 here that the subsidiary has generated, remember the acquisition date is April 1st. So the 60 is a profit that the subsidiary made between January 1st and March 31st. This profit here of 60 of the subsidiary is not a profit that has been generated by the group. And that is a purchased profit. The profit has been generated by the previous shareholders, by the old shareholders. And that's why when the company S is sold now, then obviously the outgoing shareholders, they would ask the acquirer to pay them out this profit. Because once I sold my shares in S, I do not get dividends anymore. So those profits are lost for me. So the 60 here is a purchase profit. It's not a generated profit. And therefore, it will not appear in the consolidated balance sheet or consolidated income statement. I will only see the post-acquisition profit. So any profit that S makes after April 1st obviously is a profit made under the responsibility of the group, and therefore this post-acquisition profit would count for the consolidated balance sheet and would appear in the consolidated balance sheet and of course the consolidated income statement. Okay, that was the exercise B. Prepare the consolidated balance sheet at acquisition date here for the two companies. Any questions, please? No questions so far. Okay. Then let's do the A part. Now prepare a balance sheet on April 1st, assuming that PC paid 160 to acquire in a statutory merger the assets and liabilities of S on April 1st. So here we have a different type of business combination. We have a statutory merger. That means P will not spend money to buy shares, but will buy all individually the assets and liabilities of the subsidiary. Okay. Now, how do I present the balance sheet as of April 1st? Well, that means here I work actually only in the balance sheet of the parent company, because the parent company buys all the assets and all the liabilities of S. And for this, the parent company spends 160. So that means here I have, in the A case, I have the same cash outflow. So I spend 160. And in exchange, what do I get? Well, I get the equipment of S, and the equipment is valued at 200. Well, let me put this here. Existing equipment plus 200, the new equipment of the subsidiary. And my cash position is what it is. Obviously, after the acquisition, my cash position is 0. I do not get any other assets. I also get liabilities. So the existing liabilities are 80. And I buy all the assets and all the liabilities of S. That means I also take over these 40 here. That means my liabilities actually increase by 40. So you see that my balance sheet is balanced, because here I have plus 200 and minus 160 on the asset side. So after doing this, my total assets are 440. Correct. Capital net income does not change, but total liabilities is 120. So the liability side also increases by 40. That's why we have now 120 liabilities, and my final total amount of equity and liabilities is also 440. So in a statutory merger, again, I buy the assets and the liabilities individually, okay, and as a counterpart, I have a cash outflow, and then we are done. Okay, there's nothing else to do. And what do I see in this merged balance sheet? So basically, this is the parent company after merger. Well, what do I see? Well, I see all the equipment, all the liabilities, capital, and net income. And in particular, what we can observe, well, this post-merger balance sheet on the one hand, and the consolidated balance sheet when I buy the shares are exactly identical. Okay, there is no difference. That's what I said before at the very beginning. We have different legal forms of business combinations: statutory merger, statutory consolidation, or stock acquisition. But this is just a legal difference. Economically, it's the same. That's why the accounting outcome should be the same and is the same. That means it doesn't matter if we merge with company S or if I buy all the shares of company S, the final outcome is the same because the economic situation is the same. Okay, questions on that? So statutory merger, I buy all the assets and liabilities individually, and stock acquisition, well, I buy just the shares. Let's see the statutory merger from the point of view of company S. What does company S do? Well, company S has equipment of 200 and now sells this equipment for 200. Means obviously after selling all the equipment, nothing is left. But as a purchase price, they receive cash. Remember here, it's the company selling the assets and liabilities. And we also sell all our liabilities. And therefore, the remaining liabilities after doing this obviously are 0. Okay. That means after selling everything, well, I have 160 in assets, that is only cash. And I have 160 in equity, no more liabilities, so we are good. But as I said, the company now is an empty shell because except assets, there's nothing left, no operations, no nothing. That means now we will liquidate the company, which means actually we will take the existing cash and we will distribute it to the shareholders. Okay, so minus 160, and the shareholders are reimbursed for the capital that is still in the company and for the undistributed profit so far. And then everything is down at 0 and the company does not exist anymore. Been dissolved. Okay, that's a statutory merger situation from the target company perspective S, which then later is dissolved, as you can see here. Okay, any questions? Please tell me some reactions here. I would be willing and happy to repeat myself, but you need to understand this because everything after that is based on this. So are we good here or do you have questions? Okay. Seems okay. Then let's continue. So here I did in the B case, we did a stock acquisition on April 1st. As I said before, on April 1st, that's not when we do the consolidation. Basically, the first consolidation will be on December 31st. So let me put this on the following page. Okay, so on December 31st, obviously, we still have the parent company, we still have the subsidiary. Now I see in the balance sheet of the parent company, I see the investment in S at the book value 160. And obviously we are now 9 months after the acquisition. That means both balance sheets have changed since then, because in the individual balance sheet, I do my daily accounting and obviously assets liability numbers change over time. And then we are at the end of the year. And now, once again, I need to prepare, I could say, the first official balance sheet because we are as of December 31st. So how do I do this? Well, same story. Let me see. I take the balance sheet of the parent company and use this as a basis. So I set up the combined balance sheet. Therefore, I take the parent values that I have plus the subsidiary values. And obviously, I take the subsidiary values at the end of the year, at the date I do the consolidation. So here it's 210 in terms of equipment. That means we have 570. The investment is the investment. Okay, we also have now for the, let me do this, also have for the subsidiary some inventory that I need to record. So plus 80 in inventory. And cash we have at the end of the year 80 for the parent plus 40 for the subsidiary. So 120 in cash. Okay, so well, total, we don't need that here. As of now, capital, well, we still have 300 for the parent plus 100 of the subsidiary. Net income at the end of the year, we have 80 for the parent plus 180 for the subsidiaries for the full year. And liabilities, we have 220 for the parent plus 50 subsidiaries. So that's a total of 270. So we don't need those lines here as of now. Okay, that's my combined balance sheet. And then as we do it, well, we eliminate everything that is group internal. And group internal, once again, is the investment here. Okay, so I need to delete this, cancel that, and I will do so. So the investment is taken out. And I need to take out the capital, or remember the equity that existed at the date of acquisition. So what was the equity at the date of acquisition? It was capital 100, so I will delete that. And it was net income 60. Well, remember when I bought the subsidiary during this year in April, the net income was 60. At the end of the year, the net income of the subsidiary is 180. But in the year of acquisition, I need to split that in the part that is pre-acquisition, when I bought the company, and post-acquisition, which would be part of group revenue. That's why here from the 180, I eliminate only 60. The 60 that were there when I bought the company. That means I delete 160 on the asset side, and I delete 100 in capital. I delete 100 in profit, which is also 160. That means I have deleted 160 on the asset side, 160 on the liability side, and we are done. And therefore, in the end, my consolidated balance sheet will look like the following. I have 770 in assets. I have 300 in capital, still the parent company. I have 200 in profits. 80 is the profit of the parent company. 120 is the profit of the subsidiary after the acquisition date, so post-acquisition. Okay, and I have 270 of liabilities. So overall, 770 in assets, and we are good. Okay, so therefore it is important in my consolidation system, accounting software and so on, to remember the historical values that I had when at the acquisition date. Because even in 10 years, when I do the consolidation of S, I still need to remember that when I bought S, there was a profit of 60. And therefore, I need to eliminate those 60. Okay, that's the follow-up consolidation. Any questions on that? So same procedure, basically, what we have here. So first combine balance sheet, then eliminate what's internal, and then we are done. Okay, if you have no further questions so far, then we move on. So here in this first example, we acquired the subsidiary shares at book value. As I said yesterday already, that is probably not the most realistic acquisition method, or corresponds to reality. It corresponds more to reality that we pay, for example, 190 to buy the same subsidiary. You see, the subsidiary numbers did not change, to buy the same subsidiary, still with the book value of 150. So usually in real life, acquirers, investors pay more for a company than just the book value. That raises a question. That raises the following question. Why do investors pay more than the book value? Do you have any ideas? Why would investors pay more than the book value? Anyone? Well, okay, they pay the market value, yes. So that means we could say, if I take this as reason number one, they pay a premium, first of all, premium above value based on market value, yes. Indeed, usually when we value companies, we use the discounted cash flow method. We don't take the book value. And well, it depends, but many times, and not systematically, but many times the discounted cash flow valuation method leads to a value of the company that is much higher. Okay, so discounted cash flow, which means a different approach than accounting, is used. That's also true. Then because of goodwill, okay, but we have to, that's correct. But, well, what is actually goodwill? Kantran. Goodwill is true, but what is actually goodwill? What does that mean? And for other people, do you still have other ideas why people pay more for a company than the book value? Ideas. Yes, that's true. Goodwill is a premium, but that means goodwill is already captured here. So if you tell me it's a premium and it's right, well, premium, I wrote this down already. So that means goodwill is the premium. So any other ideas why someone would pay more? Growth of the company, yes, growth potential. Okay, obviously that is also reflected in the discounted cash flow method. Yes, but I would pay money for this. Okay, the brand of the company, that is true. So I put this here, but key and tran, when you say the brand of the company, isn't the brand already in the balance sheet? You know, because here we look at the balance sheet of the subsidiary, we have assets, and isn't the brand name not part of the assets here, and therefore part of the book value? I don't know. It's a question. Huh? Do we see the brand name already on the balance sheet of S, or do we not? Okay, so book value is historical data mostly. Fair value is future value. That's true. It's also related to discounted cash flow. So that's correct. Hangwu, how about the brand value? Is the brand value in the balance sheet of S, or is it not? My question, because if the brand value is already in the balance sheet, the brand value would be part of the book value. So when I buy the book value, I buy already the brand name. Therefore, important question, is the brand name on the balance sheet or not? Maybe it depends. I don't know. Okay, so goodwill is company reputation, clients. That's true. Okay. And Angwu, brand is already an intangible asset, but now you're asking me. That's not right, huh? I was asking you, so not so supposed to give me an answer and not to ask me back. But okay, that means how do we account for brand names? How do we account for intangible assets in general? Well, indeed, there are specific accounting rules. Okay, and if the brand name is internally generated, then the brand name will not be accounted for by the subsidiary. So if I create my company and I create a brand, and over time this brand becomes more and more known and therefore has a higher and higher value, the brand name will not be accounted for in my balance sheet because it's an internally generated brand name. That means the brand name of Apple is not in the balance sheet of Apple. And the brand name of Google is not in the balance sheet of Alphabet. And the brand name of Coca-Cola is not in the balance sheet of Coca-Cola. In all those cases, we have internally generated brand names, trademarks, and so on, and they are not in the balance sheet. Okay, so now, obviously, if I buy Apple, the outgoing shareholders would tell me that I would need to pay them quite a lot of money to buy the brand name. And obviously, that would be a very good reason why investors would pay more money than what I see just on the Apple balance sheet. Okay. So internally generated brand names, they are not in the balance sheet. Okay. Brand names come only in the balance sheet if I purchase them. So if I'm the buyer of another company and I pay money for this other company, then and I pay money for the brand name of this other company, then obviously the brand name is a purchase brand name, and I would need to account for this in my balance sheet because I buy it. So not putting an internally generated brand name on my balance sheet is more or less a general rule for intangible assets. Okay, intangible assets that are generated internally, you cannot put them on your balance sheet. There are a few exceptions, however, but usually you cannot because it's not possible to value them objectively. Well, remember, I need faithful representation, objectivity in a sense. Well, how do you objectively measure a brand name on which that is a unique item? For example, there has never been a transaction on this brand name because nobody ever purchased Apple. Therefore, we really have no real clue how to value the brand name. And therefore, when it's internally generated, we cannot put it on the balance sheet. Okay, maybe there are other reasons why people pay more for the subsidiary than the book value, and this reason was already mentioned actually by Hang Wu. That is, the book value is not the fair value, and that means even for the existing assets of the subsidiary, it may be that the fair value of those assets is higher than the book value. So for example, maybe here the asset is a building and the book value of the building is 170, but the same thing for the selling shareholders and for the acquiring shareholders. Remember what we said in the very beginning, the book value is not relevant. The fair value at the date of acquisition is relevant. And therefore, maybe the building has a book value of 170, but maybe it has a fair value that is higher, fair value of 200, and so on. Okay, that's also possible and would be another reason why why investors pay more for a company than the book value. So the reasons number two that you have, so the brand name, fair value of assets are different than the book value. By the way, the fair value of liabilities also be different than the book value. They can be higher, higher or lower, depends on. That's also possible. For those reasons, we call those reasons as a group valuation differences. That means, in a sense, here we are talking about accounting errors. Obviously, it's not accounting errors in the sense that we made a mistake or the financial statements are wrong. It's just that in my balance sheet here, it reflects accounting regulation that is based on historical cost. In an acquisition process, the fair value is what's interesting me. And therefore, economically speaking, this balance sheet is wrong. Therefore, we have accounting errors. Well, since here we have accounting errors, well, we can solve that problem. And how do we do this? We do this by correcting the accounting numbers. If I know the accounting numbers are incorrect, well, change them and make them correct. So we can do this. Okay, and then reason number 2 has disappeared. For reasons number 1, the premium, the fact that we use a different valuation method, the future growth. What else? By the way, what is the number 1 reason why that the acquirers use to justify their acquisitions? Do you know what that is? It's always mentioned. One company buys another, and they will always give that reason. Number 1 reason why people buy other companies. Synergy, exactly. Synergies. So synergies would also be a reason why I would pay more. So premium, discount, cash flow, synergies, etc. Now, all these items here, actually, there is no accounting treatment for that. In accounting, I cannot account for the future growth. That's not possible. I cannot account for future synergies. I have to wait until those synergies realize year after year. That means there is no real accounting treatment here for the number 1 reasons. And that's why we take all those number 1 reasons together and call it goodwill. So the goodwill is actually all of this. So I don't know what it is specifically. So if I have a goodwill of 200, I cannot tell you if the 200 is the synergies or the growth or DCF or the premium or all of this together. I don't know. I just know in total, I paid a goodwill of 200. Okay. So that means now for our consolidation procedure, remember combined balance sheet, eliminate what's internal and so on. For our consolidation procedure, before I can combine the balance sheet, eliminate things and so on, I need to add a step. And I need to deal with all those problems. I need to recognize the goodwill, I need to correct the accounting numbers and so on. And this part of the procedure is called purchase price allocation. So that means now, before and in real life, before I can start to consolidate, the very first thing I need to do is a purchase price allocation. That means, in other words, I have to ask myself, I paid 190 to buy the subsidiary. Okay, that's the money I spent. What did I actually purchase? What did I buy with the 190? And I can do this in several ways. For example, that's one possibility in the slide. I can compare the purchase price with the book value. And that means I have a difference of 40 that I paid more. And then the 40 can be explained by 2 reasons. Remember the 2 that I mentioned. It's either based on a valuation difference or the difference is based on goodwill. And actually, the goodwill will be identified as the remaining value. That means I have a total difference of 40. And first, I will check if I have valuation differences. And if I do have valuation differences, I will deal with them. Remember, valuation differences are accounting errors, so to speak. So I will correct the accounting errors. That means I will revalue the equipment, for example. I will revalue my liabilities. I will now incorporate the brand name in the balance sheet of the subsidiary because it's a purchase brand name. So I will correct all these valuation differences. And if after correcting valuation differences, there is still a remaining difference out of those 40, this remainder is goodwill. So here in our example, we have a total difference of 40. Maybe we say, and I just give you that number, it's not based on anything that you can see in the slide. I tell you the valuation difference is 30. For example, that's the value we assign to the brand name that I bought. That means I have a total difference of 40. 30 can be explained by the brand name. Well, the remaining 10 cannot be explained specifically. Well, that's why it's goodwill. Okay, and I end up with goodwill of 10. So goodwill is a remaining value. That's the remainder after I dealt with the valuation differences. Okay, so that's one way of doing this. A second way of calculating goodwill is to say I take the purchase price, which is 190, okay, and I deduct from the purchase price, I deduct the fair value of the subsidiary. What is the fair value of the subsidiary? Well, it's the book value plus or minus all the valuation differences. So since here we have 30 of valuation differences and the book value is 150, that leads to a fair value of 180 in this example. Okay, so if I pay 190 to buy a fair value of 180, the remaining difference obviously is 10, and the 10 is my goodwill. Well, okay, so either you take total difference and then you allocate the difference to valuation difference and goodwill, or you calculate goodwill directly. Either way, it leads to the same result. If goodwill is positive, like in our example, we put it as an intangible asset on the balance sheet. Okay. Obviously, goodwill can also be negative. So negative goodwill or badwill. In this case, you recognize a profit in the income statement. So a badwill, a negative goodwill, is given when you pay less for a company than the fair value. So here the fair value is 180, but maybe I pay only whatever, 160. That means there would be a badwill or negative goodwill of 20. Okay. Especially in the banking sector right now, I don't know in Vietnam, but in Europe, in the banking sector right now, systematically, there are badwills when we have acquisitions on banks. That means also, remember, goodwill, there is a rather positive outlook, future profits. Badwill means, well, there's a rather negative outlook, future losses, for example. And given the rather fragile position of some banks in Europe, that's not a surprise, really. No? Okay, so purchase price allocation, that's very important. That means, first of all, I need to fair value all assets and all liabilities of the subsidiary. Obviously, that is something I have already done before I actually bid for the company. Because before you make an offer for a company, you need already to check out what type of values this company has, how much am I willing to pay. So obviously that means I checked out already the fair values of assets and liabilities before that. But now we are after the deal, and now I need to be very precise because I need to assign those new fair values to all assets and all liabilities of the subsidiary. And here are some methods how we do this fair valuing. So for example, obviously for intangible asset, I use estimated or appraised values. For property, plant, and equipment, I may use market values for used equipment and used PPE. I use a different method for finished goods. That is how much can I sell them. Raw materials, the fair value would be how much does it cost to replace them. Marketable securities, well, what's the market value of those? For cash, accounts receivable, accounts payables, usually we use book values. Long-term debt, for example, I use the present value of the debt. And for pension obligations, same thing. I use the present value of obligations minus the present value of pension assets eventually. So usually I will ask auditors, obviously, to help me with that purchase price allocation. Okay, knowing this, let's go back to our example, 2 slides before this. So I buy 100% of the shares of S for 190. This is the original balance sheet of S, and now I correct my valuation differences. That means I set up the balance sheet of S, but at fair value. And here in the slide, we identify the valuation difference of 30, for example, related to a brand name. Well, now I will incorporate this brand name in the balance sheet of S. So plus 30, because remember, from a group perspective now, it's a purchased brand name, a purchased intangible asset. Purchased intangible assets need to be in the balance sheet. Therefore, I put it in the balance sheet. Given that all the other values are identical, nothing else changes, to balance my balance sheet, I also increase equity by 30. Now remember, equity is assets minus liabilities. Well, now my assets are 200, liabilities are 20 still. That means my new equity, or equity at fair value, is now 180. So I need to fair value the balance sheet of S as a result of my PPA, my purchase price allocation. And very important, this balance sheet here is only for internal purposes. We do not modify the official balance sheet of S. That is the official balance sheet of S, and since S is whatever, a French subsidiary, well, this balance sheet, the official balance sheet, fulfills French accounting requirements, and in French accounting, it is not allowed to put the brand name on the balance sheet. Okay, so I cannot modify the official balance sheet of S. I modify it only for internal purposes. Which means also that I need to insert the plus 30 here, the valuation differences in general, every year. Okay, I need to do this every time I consolidate S. Because every time I consolidate S, my starting point is this balance sheet, and that means the brand name and the other valuation differences are missing. And that means I need to reincorporate them every year. Okay. And every year I will reintroduce the same values, because that's very important. The purchase price allocation is done only once. It's only done once at the date of acquisition. Okay, only that. Because remember what we said about the purchase price or acquisition accounting at the very beginning. So the target company will be based on fair values, okay, but fair values determined at the date of acquisition, okay, and that clearly refers here to the purchase price allocation. So the purchase price allocation is only done once at the date of acquisition, not every year. Okay, which means here, as I said, the plus 30 that we have as a Brent, the plus 30 that we have as a Brent value, I need to introduce the same amount every year, same accounting entry, which means actually I can program this in my software. So I don't need someone actually doing this, but I need to put that somewhere in my system. That means I need to remember, even 50 years later, because in 50 years I still need to a consolidated subsidiary, the brand name, even in 50 years, will be missing. So even in 50 years, I need to add plus 30, because that was the brand name when I bought the subsidiary 50 years ago. Okay, so I can program this in my software. Okay, so I fair value my subsidiary, and from here on, we just follow the regular procedure now. That means now I set up the combined balance sheet, and I add up all the numbers. That means here total assets for the subsidiary are 200. That means now in my combined balance sheet, it includes my brand name. Well, the brand name is now here. And it should be there because the group purchased the brand name, and therefore it should be on the group financial statements, on the group balance sheet. Then I check out in my combined balance sheet what is internal. Well, the investment is internal. Okay, the fair value of equity here, the 180, are not provided by outside shareholders, but by the parent company, and therefore is also internal. So I need to cancel that. But obviously it's not balanced, because I delete 190 on the asset side, I delete only 180 on the liability side. That's not balanced. Why not? Well, because goodwill is missing, and therefore I will now also introduce goodwill plus 10. Okay, so that means on the asset side, overall, I deleted 180. On the equity side, I delete 180, and now we are balanced. Assuming there are no other internal transactions, we are done. And I end up in my consolidated balance sheet with a goodwill of 10, with total assets of 240, including the brand name that we have. It's all there. Equity is still equity of the parent company only because we do this here at the date of acquisition. And liabilities are total liabilities as it was before, 150. Okay. So that means when I see a goodwill in the balance sheet somewhere, this goodwill can only be a goodwill that is based on an acquisition. And companies who have a lot of acquisitions, so aggressive takeovers, a lot of external growth. So companies that do a lot of acquisitions, usually they will have a lot of goodwill. We can see here, calculation-wise, goodwill is like a leftover. You know, it's a final amount that I don't know what to do with, basically. But that's the way how it's calculated. Don't get fooled. Obviously, goodwill in terms of amounts is usually a very important item. For example, in France, you know, the leading stock index in France is called CAC 40, 40 biggest companies. Well, on average, goodwill is 25% of the balance sheet. On average. Some companies it's more, other companies it's less. And that means for many groups, actually, goodwill will be the most important asset on the balance sheet. More important than brand names, more important than property, plant, and equipment, and so on. So calculation-wise, it's a leftover. I don't know what to do with, but in terms of importance, it's much more than that. Okay. So I don't know, you as potential financial analysts, how would you interpret the goodwill? Or let me rephrase my question. When you see a balance sheet with a lot of goodwill, you know, after an acquisition, would you say that this is a positive sign? So having a lot of goodwill is rather good and would be positive from an investor perspective, or is a lot of goodwill rather negative, not so good, and you should be cautious? What do you think? Is goodwill good news or bad news for an investor? Okay, well, let's do a poll, then everybody can answer. So let's put it this way. Goodwill is good news. You agree or do you not agree? Yes or no? Well, sorry, my system is in French, so goodwill, is it good news? Yes or no? Okay. Well, you see, it's almost a split, 50-50. Well, you can't see, but I can see. Okay, so roughly we have 50-50. Okay, so for those who said it is good news, why would you say so? Why do you think goodwill is good news? Anyone? Some of the 10 people who said it's good news? Why do you think goodwill is good news for investors? Someone? And for the 7 people who said it's not good news, why do you think it's not good news? Anyone? Okay, goodwill is positive because we said it's synergies, and if I'm expecting a lot of potential synergies, indeed, that's good news, huh? And should be value enhancing for the stock price, for example. That's correct. That would be a reason why we would see that positive. That means I need to check how realistic are the synergies. So I need some more details. When they say synergies, and usually companies do this in the presentation, when they justify the purchase price, usually they give you some more details on the synergies. You know, maybe it's cost savings or maybe it's revenue synergies, and how much over how many years, and how do they expect to realize them, and so on. So having a lot of goodwill in that sense means there's a lot of potential of future good news. That would be positive. What is negative? Well, negative is, well, I don't really know if it is the synergies. Maybe the goodwill is only based on the fact that there was a bad negotiation. You know, we overpaid the company. Maybe it's we are thinking there will be future synergies, but they will never show up. So that means I paid a lot of money, but for nothing, basically. So that means, well, goodwill, a lot of goodwill means also we have to be cautious. Was it really justified to pay all that money? Obviously, we can give no general answer. It depends on the transaction. That means for every transaction, we have to check it out. How high is the goodwill, and is it really justified? And therefore, in the end, is it good news or is it bad news? Well, we can say that in general. Sometimes it works out, sometimes it does not work out, obviously. Okay, peoples. Then it's 8 o'clock. I propose that we do a break here. Okay, so 30 minutes, and we meet again at 8:30. Okay. Thank you very much. Then let's continue. So in an acquisition, the first step I need to do before I can do the consolidation is I need to do a purchase price allocation. And based on this, I recognize if there's a goodwill or not. Okay, so let's try this for the exercise number 2. So down here we are. Sorry, let me see this here. Exercise number 2. And same thing, on April 1st, we have the 2 individual balance sheets, and you see these are the same balance sheets that we had in the exercise number 1. But now we have some additional information regarding S. For example, we know that the fair value of the equipment is 350 for the first information. And also S has developed a brand name whose fair value is estimated at 100. And as we can see here in the balance sheet of S, this brand name is not accounted for. Okay, in the A requirement, once again, we do a statutory merger, and we assume now that the parent company paid 450 to acquire the subsidiary as of April 1st. Okay, and to prepare the balance sheet of the parent company after the merger. Okay, but before we do this, we need to do our analysis, and we need to do the purchase price allocation. So PPA. In order to do this, there's different possibilities. So we can calculate the fair value of equity, which is also called the fair value of net assets. And the fair value of equity equals the fair value of assets minus the fair value of liabilities. That's the first possibility. What is the fair value of assets? Well, we have for the equipment, we have a fair value, we have a fair value of 350. And we have for the brand name a value of 100. So fair value of total assets is 450. And the fair value of liabilities, here we have no further information. That means we assume that the book value and the fair value of the liabilities are the same. So we have a fair value of liabilities of 40. Therefore, we can say, that the fair value of equity is 450 minus 40, which is 410. Okay, so fair value of equity is 410, fair value of net assets. Goodwill now is defined as the difference between the purchase price and the fair value of net assets. So the purchase price here in our case is 450, and the fair value of net assets indicated as 410 means here we should have, or we do have, a goodwill of 40. Okay, that's one possibility. Or we do separate possibility, so leading to the same result. We compare the purchase price with the book value of the company. The purchase price is 450. Value of the company is the same as before. Here is the value of book value of equity is 160. So I have 160, and that means I have difference of 290. Sorry, 90. Now this difference relates for part 2, and that's what I will deduct. So I have a difference of 290. Excuse me, 290, and thereof I have valuation difference of how much? Well, I have a valuation difference in equipment. The book value of equipment is 200, but the fair value of equipment is 350. So that means my valuation difference related to equipment is 150. So difference between the fair value and the book value. So I have a total difference of 290. For 150, I can explain this because of the equipment. And I can explain another part of this because of the brand value, which is 100. Okay, so it means I have a, a total valuation difference of 290. 150 is explained by the equipment. 100 is explained by the brand name. There is nothing else. That means there is a remaining difference of 40. And this remaining difference, since it cannot be explained by valuation difference, is goodwill. Okay, so either way, doesn't matter which method you use. We do have a goodwill, we have a brand name of 100, and we have equipment with a valuation difference. Okay, so this is the purchase price allocation. And now, since we know all this, we can prepare in the A case the balance sheet of PC after the merger, which means that the parent company now spends 450 by all the assets and all the liabilities of A, including the brand name, including goodwill, and so on. Okay, that means what do I get? I have already equipment of 240, and now I buy the equipment of the subsidiary, but I buy it at fair value, of course. So the fair value of the equipment is 350. So I get this, and therefore my total equipment now is 590. I also buy the brand name of the subsidiary, and it has a value of 100. Okay. And I also take over the liabilities of the subsidiary. Here we said the book value and the fair value are the same. So for 40, it's over, so that I have total of 410. Okay. And one thing is missing. Obviously, when I spend the 450 in cash, I also buy a goodwill. Its value is 40. Okay, so you can see I have plus 350 plus 140 here and minus 450. So overall, my asset side increases by 40 and is now at 730. And the liability side also increases by 40. And therefore, we have on both sides now the same thing. And this will be my final balance sheet. So after the merger, I see goodwill, I see a brand name, and I see all the other assets. Okay, so far so good. Do you have questions on this so far? Well, because the book value of S is 200, okay, but the additional information tells us that the fair value of this equipment is 350. So for the consolidated accounting or for the accounting of the merger, the fair value is relevant. And that means I buy this equipment for 350. I do not buy it for 200. And since I buy the equipment for 350, I need to account for 350, okay, and not 200. That's the important thing. Only the fair values are relevant, not the book values of S. I don't care. S is the selling entity. It doesn't matter. Okay. Are we good? All right. So this is for the merger situation. Okay. Now the same thing, but here we assume that the parent company now buys 100% of S for 450, but now we buy the shares. So stock acquisition, not a statutory merger. Well, also in a stock acquisition, the very first thing I need to do is the purchase price allocation, and it will be strictly the same. So fair values are relevant. My goodwill is 40, my brand name is 100, etc. All this remains the same. Okay. So I did this already. Then I need to prepare the balance sheet of S and put it at fair value. Okay. That means in terms of the equipment, I have an original value of 200. Now I need to add 150 because we said the fair value of the equipment is 350. I need to incorporate in the balance sheet of the subsidiary a brand name, and the value is 100. That means since I incorporated a higher equipment value of 150 and I added a brand name of 100, I increased my total assets by 250. In order to balance the balance sheet, I need to put 250 on the equity side of the balance sheet in equity. Remember, equity is assets minus liabilities. Now my revalued assets actually are 450. My liabilities are 40. That means my revalued equity must be 410. That means I need to add 250. Now, how do you call this item? Here, the 250 doesn't really matter. So, for example, I could put this in retained earnings or revaluation, whatever. It doesn't matter. Why? Well, because in the consolidation process, the 250 will disappear anyway. and therefore it's not relevant. It doesn't matter. Okay. Now, once I'm done with this, just the thing I need to do is the combined balance sheet. So here I start with the subsidiary, doesn't really matter. I need to set up my combined balance sheet. So I take the subsidiary values and I add the original, obviously, that I don't have here anymore, the original values of the parent company that we had here. And remember that the parent company spent all their cash to invest in S, and the amount of the investment is 450. That's what we had originally. Okay, so the subsidiary has an equipment of 350. I add the equipment of the parent company, 240. Total equipment is 590. Okay. I have a brand name. Okay, I have an investment. My combined balance sheet of 450. Okay, that's it. On the asset side, I have capital of the parent plus 100 for the subsidiary. I have net income of 20 for the parent plus 60 for the subsidiary. I have this retained earnings, revaluation for the subsidiary, and liabilities. I have 370 for the parent plus 40 subsidiary, which is 410 in total. Okay, and now I need to eliminate what's internal. Okay, so as always, I will eliminate the investment, which is 450. So nope, not this one, which I will delete. I will delete capital at the date of acquisition. Okay, 100. I will delete the net income because it's a purchase profit at the date of acquisition. And I will also delete the revaluation reserve because once again, this is equity paid for by the parent company and therefore it's internal. Okay, so I delete 450 here and I delete 250 and 160 here. So 410 on the right side. So it's not balanced. Why not? Well, because goodwill is missing. So I will incorporate now goodwill by plus 40. It means here in the end, I have canceled 410 on the asset side. I have canceled over the 3 lines here, 410 on the equity and liability side, and we are done. So final capital is 300, is 200. And on both sides of the balance sheet now, we have 730. Okay, with total equipment value 490, brand name, and all the rest. And if you compare to that of the statutory merger, well, you see that it's exactly the same. Sorry. Okay. So number 1, purchase price allocation. Number 2, fair value S. Number 3, add up everything. Number 4, eliminate what's internal and recognize goodwill. And then we are done. And statutory merger balance sheet or consolidated balance sheet lead exactly to the same result. Questions so far? Please. Questions? Apparently not. Okay. then we continue with the C part. Now, same thing. We are now on December 31st, so 9 months after the acquisition. We have the balance sheet of PC, we have the balance sheet of S, and now we need to prepare the consolidated balance sheet at the end of the year. Okay, before we go to this exercise, we need to go back to the slides. Because, okay, at the date of acquisition, I do my purchase price allocation. But the question is, what happens to those values and the valuation differences that I have and the goodwill? What happens to those values over time? So 9 months later, 1 year later, 20 years later. Okay. So I need some rules on the follow-up valuation of all those items. And here they are. Okay. The valuation differences that I have here. Well, what do I do here? Well, I apply the same accounting treatment that I apply on the items that were assigned to. So for example, in our case, we had a brand name. Okay, well, a brand name is not amortized, it's not depreciated, but we do an annual impairment test to see if there's a loss of value on the brand name or not, compared to the value at acquisition date. Equipment is depreciated. Okay, so if I have a valuation difference that is related to equipment, I need to depreciate the valuation difference over time. Maybe my valuation difference relates to liabilities. So I have to check how the liabilities are accounted for, how they are reimbursed, and I need to adjust for the difference, etc., etc. So I just apply regular accounting on the valuation difference wherever it is located. For goodwill, well, goodwill, the follow-up rule is we don't amortize goodwill in IFRS. We also do an annual impairment test. Okay, so it means we calculated a goodwill of 40 in our case. Well, we need to check every year if this number 40 is impaired, and then I need to write the goodwill down or not. And I will show you later on how we do impairment tests on brand names and goodwills and all this technically. Okay, so therefore going back to our exercise, where am I here? Going back to our exercise. So here I have 2 valuation differences. I have one valuation difference that is related to a brand name. So we need to do an impairment test on the brand name. Here in this exercise, we have no information that there is an impairment for the brand name, which means, well, I consider the brand value has not changed and is still 40. We need to do an impairment test on goodwill. We calculated an original goodwill of 40 at the date of acquisition. Here we have no information that there is an impairment of goodwill. Therefore, I assume that the goodwill value has not changed. So very important, I repeat this. We calculate goodwill only once at the date of acquisition. We do not calculate goodwill every year again. Okay, so goodwill is 40. That's the historical acquisition cost of goodwill. It does not change except for impairment. But here we have no impairment, so we stick with that. And I have also a valuation difference that relates to equipment. Now here we have to be careful. So I know that the remaining useful life of the equipment is 10 years, and we use straight line depreciation. But now we have to be careful because the equipment value is basically split in 2 parts. Remember, the equipment is in the balance sheet of the subsidiary originally accounted for at 200. And the subsidiary does already depreciate the 200. So I will not again depreciate the 200 because it's already done. That means the fair value of the equipment is 350. And I need to separate this in the book value that exists already at 200, and this book value is already depreciated. So that means there's nothing to do. and the valuation difference of 150. Now, the subsidiary does not account for the valuation difference of 150, but on a group level, we need to account for this, which means that the subsidiary does not depreciate the valuation difference, but we, on a group level, we need to depreciate the valuation difference. Okay, and that means for the valuation difference related to equipment of 150, I need a depreciation. And how much is the depreciation? Can you tell me? What is my depreciation for the valuation difference? Anyone? Hello, hello. You're still there? What is the depreciation of my valuation difference? Well, it's not 10, but it's over 10 years. So indeed, we need to calculate 150 over 10 years. In other words, we have 15 per year. But we need to be careful because here we are at the end of year N. We're doing this on December 31st of year N. And my acquisition date is April 1st. So that means for the first year, I do not depreciate for a full year. I depreciate only for 9 months because I buy the equipment in April and I do the depreciation therefore only for 9 months out of 12. Which is, if I check my solution, which is 10.75 if I remember, no, 11.25. Okay, so exactly, that's what you said, 11.25. That would be the depreciation of the first year. Okay, now we have this preliminary thing, and that means now I need to fair value the balance sheet of S as we did before. That means here, well, I have at the end of the year, I have an equipment value of 210, but I remember upon acquisition, there was a valuation difference of 150. And therefore, I need to integrate the 150. I remember also there was a brand name. Brand name and acquisition cost was valued with 100. So I add 250 on the asset side, and we remember we put this in retained earnings. So it's the same 250 that we had before. This, well, here or here. Anyway, I include 250. And remember, I need to do this every year. Okay, so here we are good. Fair value. Then I need to do an impairment test on the brand name, but there is no impairment, so nothing to do. An impairment test on goodwill, but there is nothing, so nothing to do. And I have the depreciation on this equipment value. That means here I need to deduct 11.25 of depreciation. And that means the profit of the subsidiary from a group perspective is not 180. It is 180 minus the additional depreciation expense I have from a group perspective. Okay. And that means from a group perspective, actually the profit of the subsidiary is 168.75. Okay, so I need to revalue on the balance sheet of S, and I need to consider the subsequent measurement that I have, depending on if we talk about goodwill or if we talk about valuation differences that I have. Okay, so I need to do this, and this is then the balance sheet at fair value at the end of the year. Okay, are we good so far? Means here my equipment is actually 348.75 and 75. Okay. What happened, for example, if we had an impairment on the brand name? So here we don't have one, but assuming we had one, and the brand name was valued 100 when I bought the subsidiary, but many years later, well, there is something bad happened with the brand name, and the brand name has lost value, is impaired. For example, impairment of 40. Well, then I would deduct 40 from the brand value, and I would account for an impairment loss in the income statement of the year I do the impairment. Minus 40, etc. If there was a loss on goodwill, I would do the same thing. Okay? So it's pretty much straightforward and regular accounting, but based on the fair valued balance sheet of S. Okay, once I have this, the next step, and here again I use balance sheet of the subsidiary, we have to prepare the combined balance sheet. Okay. That means I take the asset value of the subsidiary, okay, plus the equipment value of the parent. Means we have total assets of 748.75. I have the brand name. Okay, I have inventory of the subsidiary. I have cash, 40 for the subsidiary plus 80 for the parent, 120 in total. And obviously also in here I have the investment in S out of the balance sheet of the parent company accounted for 450. I have capital, okay, 300 for the parent plus 100 for the subsidiary. I have the retained earnings. I have net income. Net income of the subsidiary is 168.75 plus 80 of net income for the parent company. And I have liabilities, 510 for the parent plus 50 for the subsidiary, so 560 in total. Okay, just all added up. Then I eliminate what's internal. Okay, so I delete the investment of 450 as always. I delete capital of 100. Okay, same as previously. I delete the retained earnings revaluation reserve here. Okay, and I delete 60, the net income that the subsidiary had when we purchased it. That means here out of the total net income, I will take out 60. Okay, so 168 is the full year profit for the subsidiary based on a group view. Out of the 168, I eliminate the 60. That means here I have 250, 160, so 410 in total that I delete on the equity side. I delete 450 on the asset side. Okay, so that's not balanced. Why not? Well, because goodwill is missing. Okay, let's see here. Is missing, and we have calculated goodwill as plus 40. It's not impaired, therefore it remains. So means here I delete 410 on the asset side. Okay, I delete 410 here in equity. So we are both balanced and we are finished. Okay, and my final balance sheet, I have total equipment, inventory, cash, goodwill. And the total value of all this is, if I check quickly my solution, 1048.75. That's what we have. And here capital is capital of the parent company. We have a profit of 188.75. That means we have 128. Sorry, that's not correct. No, something is wrong here. 240. No, it's okay. So we have 80, a profit of for the parent company, and 108 is the post-acquisition profit of the subsidiary. And we have 560 here. That means overall we are done. Total equipment is not correct. Yes, it should be 708. But yep, now we are good. I checked with my solution to be sure, which is always better than doing this. Okay, and on both sides we have 1048 point. We should be good. Okay, here we go. Okay, the question, why don't we depreciate 350, but only the difference? Well, because in the original balance sheet of S, the equipment is already incorporated and is already depreciated. Now remember, in the balance sheet of S, we have the 200 of equipment, and S, when they calculate their net income, have already deducted depreciation. So those 200 are already depreciated. That means I need to depreciate from a group level only the additional 150. If I did what you propose, that means recalculated depreciation on the full 350, that means there would be twice a depreciation of the 200, and that would be incorrect. Well, remember the 200, the book value of the equipment is already depreciated, so that means I need to add only the additional amount I recognize on the group level, which is 150. Okay. Okay. Then we are good. Okay. Are you fine so far? Or any further questions on how we do this, please? Anyway, I post the solutions after the class today. So maybe tomorrow before our next class, you may go through the solutions and ask me questions if you have any. Some people are writing, but okay. Why do we have minus 60 here in net income? Well, remember, that's the 60 that the profit that the subsidiary had when we purchased it. And you see here also, when I did the very first consolidation, I eliminated 60 from net income. That was in April. Okay, so I eliminate fully the profit of the subsidiary because it's at acquisition date. Now I do the second consolidation at the end of the first year. And that means here the subsidiary has a total profit of 168. We agree on that. But the 168, actually, this profit is composed of two parts. 60 is pre-acquisition profit. Okay, and we have the other 108.75, that is post-acquisition. Okay, I always need to eliminate the pre-acquisition profit. Okay, I need to take this out. And I need to take this out every year. And that's why I put minus 60 in the net income. So here we are in the same year. We are in year N. but obviously in n+1, in n+2, for the whole future, I always need to do the same elimination entries. And as I said, I need to remember that when I purchased the subsidiary, there was a profit of 60. My question now is, in the following years, okay, when I do the consolidation, where do I eliminate the 60? Remember, I need to do this all the time. I need to eliminate my investment every year. I need to eliminate capital, and I need to eliminate the 60. But where do I take the 60 from in the next year, in n+1, or 10 years later? Where do I take the minus 60? From which item in equity do I reduce them? Do you know that? For example, I could do minus 60 in net income of the subsidiary every year. I could do this. Is that the correct solution? Taking the 60 out of net income every year? Is that what I should do? Any ideas? No ideas? So it would be incorrect to take the 60 out of net income every time I do consolidation. Why? Well, because net income, the income statement, reflects the profit of the year. Okay, and well, now we are in 22. In 25, I have the net income of the parent company. I have the net income of the subsidiary. Both are post-acquisition. Both are generated under the direction of the group, under control of the group. And therefore, my group net income in 2025 should be the profit of the parent plus the profit of the subsidiary. Why should I take minus 60 in the profit of 25? In 25, there is no acquired profit. So I cannot do the adjustment in the net income of the following years. The adjustment in net income is only in the year of acquisition, because that is when I buy this profit. But in the following years, I cannot use net income anymore. Therefore, I have to ask myself for the following years, well, where are the profits of the past? So I pass on the question to you. Where are the profits of 20 and 19 and 2018 and 17? Where are they in my balance sheet today? Well, not capital. Capital is the number of shares a company has issued, but in retained earnings, exactly. They are in retained earnings. Okay, so since the profits of the past are in retained earnings today, what I will do is in the future, I will take the 60 out of retained earnings. So in n+1, and I do this independently what the retained earnings are. Maybe there are none because I pay dividends all the time. Well, it doesn't matter. In this case, my retained earnings would have a negative figure. Why not? It's all possible. But I would do minus 60 in retained earnings every year, all the time, as long as I consolidate the subsidiary. Which means that in the future, my elimination entries are always the same. That means recognize the goodwill of 40, delete the investment for 450, delete capital for 100, delete retained earnings for 250, and delete retained earnings for another 60. Okay, so retained earnings 310 actually, 250 plus 60. That would be exactly the same accounting entry every year. Therefore, I can program this in my software. The software will do this automatically because it will be the same items and the same numbers every year. So even in 50 years, if I consolidate the subsidiary here, it would be exactly the same accounting entry. Okay? And that's a general rule in consolidation. If I have something that hits the income statement in 1 year, I need to repeat this accounting entry in the future. Well, then in the future, this number would hit retained earnings. Okay, because I cannot do the same item multiple times in net income. Okay. Same thing is here. for the depreciation. You see here I have the depreciation, that's year N, the 9 months depreciation of N, 1125, and I deduct this here of net income, of course, because it's a depreciation expense. But in N plus 1, I need to fair value S. That means in N plus 1, I need to add the 150. At the end of N plus 1, I need to deduct 1 year and 9 months of depreciation, because we are 1 year and 9 months after the acquisition. That means I would need to deduct the same 1125 plus another 15. And the same thing, the 1125, I could not deduct them a second time from the net income in the following year. So I would deduct them from retained earnings. Same thing. And only the depreciation expense of N plus 1, so the 15 for the full year, would be deducted from net income. Okay, so same rule. Anything I do in consolidation that had an impact on the profits in the past, well, I will use retained earnings in the future in order to repeat those accounting entries. Okay, are we good so far? Questions on that? Any questions? That's apparently not the case. Okay, then we can move on. So as of now, we looked at cases where the parent company buys 100% of the shares of the subsidiary. But we said earlier that this is not necessary, because to control another company, I don't need 50%. I can also control another company, for example, when I buy only 60% of the shares. So how does buying only 60% modify my consolidation procedure or my consolidated financial statements? Well, not much, only marginally. So therefore, let's see here. In this following example, number 4, the parent company now buys 60% of S shares and pays 90 for this. So why do you think we pay 90 for those 60%? Any ideas? And once again, it's precisely 90. It's not 80, it's not 95, it's 90. Why? Any idea? Yes, indeed. Hier dran, because that corresponds to 60% of the book value. Okay, so it means here in example number 4, I also assume in the first step that we pay only the book value. That means no goodwill, no nothing. Okay. In this case, what changes? Well, not much, because we don't have any goodwill, we don't have fair value or valuation differences and so on. So I move on directly with the combined balance sheet. That means I add the values of the parent company with the values of the subsidiary. And here, very important, I will take 100% of the values of the subsidiary. I do not take 60%. I take 100% of all subsidiary numbers in the balance sheet and in the income statement. Remember, I add revenues and expenses. I take 100% of everything. And that's why I prefer to call this method the full consolidation method, because full means I always take 100% of the subsidiary numbers, independently of my percentage. Remember, we said that you can control another company even with 0% shareholdings. Well, even in that case, when I do the combined balance sheet or the combined income statement, I will add 100% of the subsidiary numbers. Why do I do this? Why don't I just take, like a proportional share, like 60% of the assets, 60% of the liabilities, and all of that? That's a type of proportionate consolidation. So technically it's possible. Why not? And actually it could be defended. There are different theories on consolidation. But with the current theory, we don't do this. We always take 100% because we control the subsidiary. And when I say I control the subsidiary, that means I control it fully. I control everything the subsidiary does, not just 60%. So for example, if I call the CEO of the subsidiary and I tell him or her that I want to sell all the assets, well, the subsidiary and the CEO will sell all the assets. He will not just sell 60% with the argument, well, since you are only 60% shareholder, I do only 60% of what you tell me. No, he will do everything to 100%. That means control means I fully control the subsidiary, and therefore I always take 100% of the numbers of the subsidiary. In the combined balance sheet, I eliminate what is internal. Okay, so the investment amount is internal for 90. So I leave this. But now for the equity of the subsidiary, I have to be careful because 60% of the equity of the subsidiary is provided by the parent company, and that is internal and therefore must be deleted. But 40% of the equity of the subsidiary is provided by other shareholders, you and me. Maybe the subsidiary is listed on the stock market and the 40% are some other shareholders. And the 40% equity provided by other shareholders, of course, is not group internal and therefore cannot be eliminated and should not be eliminated. Okay? So therefore, I will eliminate here only 60% of the equity of the subsidiary, which is 90. And after doing this, an amount of 60 remains in the consolidated balance sheet, remains in equity. This is the equity provided by other shareholders. So that's my 40% here, basically. That's the equity provided by other shareholders, and those other shareholders are called non-controlling interest, or NCI, non-controlling interest. An older name here is minority interest or minority shareholders. Okay, now terminology has changed. Some companies still use minority interest as a term, but the official term now is non-controlling interest. Excuse me. Okay, so that means I delete 90 on the asset side, I delete 90 in equity, and therefore we are done. I see the total assets of the company, I see total liabilities, and I see all the equity provided to the group. Most of the equity is provided to the parent company, but some equity is provided to the subsidiary. And therefore, I show here within the equity section of the balance sheet, I show non-controlling interest. Okay, that's non-controlling interest. Question on that? Not really. Well, let's have a look at the balance sheet and of Air France. Here we are. And on page 246, we have the financial statements. So here in the balance sheet in equity, you see now here I have, sorry, that's what I want. I have non-controlling interest. So I have controlling interest or equity that has been provided to the parent company, and I have non-controlling interest. So you see here the amount of non-controlling interest is rather small. What does this tell you? If I have a rather low amount of non-controlling interest, what does that mean? In terms of how do I control, how do I own my subsidiaries? My non-controlling interest here is very small. What does that mean? Any idea? Compared to maybe another company where non-controlling interests are very high compared to equity provided by the parent company or to the parent company. Some people are writing. Well, okay. So first answer, the percentage of floating stock is small, I guess. Well, yes, you are on the right path. We don't know here. Well, actually, I do know. Air France does not have any listed subsidiary. So floating stock does not apply here, but I know what you mean. What we can say is the percentage of non-controlling interest, so of shares that are not owned by Air France and by the parent company, is very small. That's what you say, Dongfan. They buy most of the equity of subsidiaries, and there are very few non-controlling interest. Okay, that's what it says. However, it is not related to golden share. A golden share, actually here, remember we're talking about non-controlling interest refers to what happens in the subsidiary, not what happens in the parent company. Golden shares usually are held on the parent company level. And if the government actually here in the equity of the parent company, the French government does hold a certain amount, but that is part of regular equity. So I would not see a golden share. Non-controlling interests usually do not have golden shares. So it means here the strategy of Air France is to mostly own 100% of its subsidiaries. And there's very little other shareholders. Compared to other companies, for example, the French luxury company Christian Dior. If you look at their balance sheet, actually the non-controlling interest is very high. It's even higher than the equity provided to the parent company. That means they work a lot with a high amount of non-controlling interest. Okay. So we see NCI in the balance sheet. Actually, we also see NCI in the income statement. Well, remember, in the income statement, consolidated income statement, we take all the revenues of all the group companies and we add them up. We take all the expenses and we add them up. If something is internal, it's eliminated. But basically here we have the sum of all revenues and all expenses, post-acquisition, of course, of all subsidiaries. And that leads to the net profit or loss. Well, 2020 was not good, but the net income, for example, in 2019 was 293 million euros. That's the total profit. Okay, but not all profits belong to the parent company, because obviously if I own only 60% of the subsidiary, I get only 60% of the profits, and 40% of the subsidiary profits, they belong to the non-controlling shareholders. And that's why in the income statement also I see a line non-controlling interest, which here for 2019 is 3 million. Well, that means the 293 million include, of course, all the profits of the subsidiary, but 3 million of those profits belong to other shareholders, do not belong to the parent company. And therefore, I have to deduct them. And what belongs to the parent company actually is only the remaining part, which is 290 million. Okay, so I see the NCI not only in the balance sheet for equity they have provided, but also every year in the income statement, because part of the profits are for them, actually. No? Okay. Are we good so far? I guess. All right. Then we may continue, unless there's a question coming up. Wu. Well, because as I said, imagine I own a subsidiary with 60%. Okay. That means 40% of NCI. Now, sub makes profit of 100. Okay. So in the consolidated net income, I integrate 100. But of the 100, actually 40 belong to NCI. So I show the total consolidated profit, including the 100. But then I show you which part of the total consolidated profit does not belong to you, but belongs to NCI. And I show this on a separate line. That would be the 40. Okay. So consolidated profit, once again, is the profit of the parent company plus 100%, remember full consolidation, 100% of the profit of the subsidiary. That is the consolidated net income. Okay, so the profit is fully in here, but not all the profits belong actually to the parent company. And therefore I show a line, the profit that belongs to NCI. And only the remaining part is what belongs to the parent shareholder. So total consolidated profit 293. I reduce that, deduct the profit belonging to NCI, and the remaining profit is the one that belongs to the shareholders of the parent company. So to the parent company and therefore to the shareholders of the parent company. Okay, Hangwu. All right, very good. Now, when I buy 60% of another company, it's not always done at book value, like in this example. But it's also maybe I buy 60% of a company and I pay once again more than the book value. I don't pay 90, I pay 120. That means it doesn't matter if I buy 60% or 80% or 100%. In any case, I need to do a purchase price allocation. So we need a PPA. Every time I do a full consolidation, I need to do a purchase price allocation. That means I need to check, is there a brand name, are there other valuation differences and so on. And also, of course, is there a goodwill? So if I pay more than the fair value, well, then there is a goodwill. So I need to calculate the goodwill. If I buy 60% or 80% or whatever, when I do full consolidation, I need to do this. Now, in case we do not buy 100%, that means in case of NCI, actually in IFRS, there are two methods how to calculate goodwill. And companies can choose for each acquisition. So that means if in 21 I do 10 acquisitions, I can use 7 times one method and 3 times the other method. So for every transaction, I can choose again and new. So here you see the two methods. We have the acquired goodwill method and we have the full goodwill method. Okay. The acquired goodwill method basically means I calculate the goodwill only for my percentage. So for the parent company percentage. So if I buy, in the example, we buy 60%. Here in the example, I buy 60%. So it means in the acquired or partial goodwill method, I would calculate the goodwill only for my 60%. Okay. And in the full goodwill method, as the name indicates, I will calculate the goodwill for 100% of the subsidiary. So not only for the parent company percentage, but for the full company. Okay, so That's just in the beginning. We'll do the example, and then I will explain to you why one method or the other and what the difference is. Okay, so let's start with the acquired goodwill method. So here I will take the purchase price, and remember the purchase price refers only to what I paid for the 60% I purchased. So here we see I buy 60% and the purchase price is 120. Okay, so it means here purchase price is 120. Okay. And then I will compare this with the parent company percentage of the fair value of the subsidiary. Remember, same thing we did before, except that it was I owned 100%. That means here I need to check what the fair value is of the subsidiary. Here in this example, that's very important. In this example here, I assume that the book value of the subsidiary is equal to the fair value. Okay, so it means here we do not have any fair value differences. There's no brand name, there's no higher equipment value, there's none of this. Okay, that's the assumption here. That means here the book value of the subsidiary is 150 and the fair value of the subsidiary is also 150. So therefore here, parent company percentage of the fair value, well, that would be 60%. That's my percentage. 60% of the fair value, and the fair value is 150. That's what we said. And that's what I see here. In the balance sheet, equity is 150. So 60% of 150 is 90. Okay, so in other words, I pay 120 by a fair value of 90. That means I overpay, and my goodwill here is 30. Difference between purchase price and what I buy, but only referring to the parent company. Okay, so here acquired goodwill is 30. Okay, very good. That means here I have my combined balance sheet, parent plus subsidiary. Once again, I take 100% of the subsidiary values. Then I eliminate the investment. I eliminate 60% of the fair value of the equity, which is 90. Okay, so I eliminate 90. So that means here I delete 120, here I delete 90. Obviously, that's not balanced. Why not? Well, because the goodwill is missing. So I will incorporate now plus 30 as goodwill. Okay, and that means here I delete 90 on the asset side, I delete 90 on the other side, and we are balanced. And we are done. And in my consolidated balance sheet, I will see goodwill of 30, all the assets and non-controlling interest of 60, which is equal to 40% of the fair value of the subsidiary. And then we are done. Okay, so now question here of Dong. If parent company buys less than 50% of S, that means two companies won't merge and won't exist. Consolidated balance sheet. Yes and no. Yes, if we assume that below 50% there is no control, then yes, you are right. If I do not control the subsidiary, no consolidation, that means none of this. This here applies only when I control a subsidiary. So that means usually I have more than 50%. But remember, once again, I can control another company with less than 50%. If I control, I need to do this. If I do not control, I don't do this, independently of the percentage. So if I own only 30%, but I do control, I need to do the same thing. If I own 80%, but I do not control for some reason or other, I don't use that. So it's not the percentage in real life that's important, it's the notion of control. You control, do this. You do not control, don't do it. Okay? So it's not necessarily the 50%. Okay, that's the acquired goodwill method. Any question on that, please, so far? Okay. If the parent company can fully... If the parent company controls, they can fully control and consolidate full book value. So I have a hard time understanding your question, Hang Wu. But if if the parent company controls the subsidiary, I need to consider 100% of the values of the subsidiary. And more precisely, 100% of the fair value of the subsidiary. I don't see that here because we assume book values and fair values are identical. So every time I control a subsidiary, I need to do full consolidation, and full consolidation implies I incorporate 100% of the subsidiary numbers, subsidiary fair value numbers. Okay, if that is your question. Okay. So this is the acquired goodwill method. Some people now criticized in the past and do criticize even today this acquired goodwill method, because they say to some extent this is not logic. Why is it not logic? Well, because all my assets, or let's say regarding the subsidiary, I incorporate 100% of the assets included here. I incorporate 100% of the liabilities included here. If I look at the income statement, I include 100% of the revenues, 100% of the expenses of the subsidiary. So everywhere in the balance sheet, I take 100% of the subsidiary. Everywhere in the income statement, I take 100% of the subsidiary. And since I use the acquired goodwill method now, there is one number in this whole set that does not relate to 100%, and this is goodwill. Because here my goodwill is only a 60% goodwill. It's not a 100% goodwill, it's only a 60% goodwill. And therefore, critics say that doesn't make sense. Why everybody is based on 100%, but not goodwill? That doesn't make sense. In order to have complete coherence, I would need a goodwill that is also based on 100%. Then everything is based on 100%, and then we are coherent. That's why they proposed and introduced the full goodwill method, because with the full goodwill method, we calculate the goodwill that relates to 100% of the subsidiary, not just to the percentage held by the parent company. So how do we do this? I take the purchase price, and remember, the purchase price is only for the part I bought, so 60% in our example, and I paid 120 for those 60%. So purchase price for the 60% was 120. In order to get to 100%, obviously, I need to add the fair value of NCI. Well, because the NCI are the other 40%, and I need to add this. So if I add my 60% and the 40% NCI, well, in total, we have 100%. So it's like a hypothetical purchase price for 100% of the subsidiary. Hypothetical because, remember, the NCI are not doing a transaction. The NCI people are not moving. I held 40% before the deal. Now the other 60%, there's a movement, but I'm still holding 40% after. I didn't do anything. I didn't purchase anything. I didn't sell anything. It's just I remain at 40%. That means I need to estimate the value of those 40%. What is the value of those 40% at the date of acquisition? It's like a hypothetical purchase price that people would have paid if they had purchased 40% at the date of acquisition, which actually they didn't. Okay, now you could say, okay, since for 60% someone paid 120, I do a proportionate calculation to know what the value is, hypothetically, of those 40%. That is one possibility. However, accounting standards do exclude this possibility. It's actually not allowed. Why not? Well, because buying 60% of a company is not the same thing as buying 40%. And since buying 60% is not the same thing as 40%, well, these differences will be reflected in the purchase price. And therefore, 40% of a company is not the same price proportionately as buying 60%. So why do you think there's a difference when I buy 60% of a company or 40%? And a difference that could justify, obviously, a difference in price. What's the difference between buying 60% of a company and 40% or 20% or anything else? Any ideas, please? Yes, indeed. Trangpan. If you buy less than 50%, you are not able to control the company. And in other words, if I buy 60%, I can control. And how does this impact the price that I pay for the 60%? When I buy 60%, I get control. That is correct. How does this influence my purchase price for the 60%? Yes, indeed. I will pay a higher price for the 60% than for the 40 because I would pay what is called a control premium. Yeah? If you take control, well, that's an economic advantage, being able to control a company. And the selling shareholders would want you to pay something to give you that advantage. They are losing that advantage, so they're selling this to you. Therefore, you need to pay something for that. So therefore, buying 60%, there would be a control premium, which you would not have for the 40%, for example. So that explains the difference between 40 and 60% and being not proportionate. However, what do you get for 40%, for example, that you do not get when you buy 10%? So when I compare a purchase of 40% or purchase of 10% of shares of a company, what do the 40% provide me that I do not get with the 10%? Yes, very good. So over 36%, well, actually the percentage depends on company law. No? In some countries, you get already a veto right over 20% over certain decisions. In France, for example, it's 1/3 of the voting rights, so 33%. In other countries, it depends. It's a company law question, but indeed, you get certain veto right, and that also means you will pay a premium for that. Maybe it's not the same as the control premium, but there will be a veto right premium. Okay. And what else do we have? Maybe 60% by at negotiated price and 40% at market price. Well, yes, maybe, but it's a little bit more complicated than that and depends on stock market law. For example, in the European Union and in France, if you buy more than 1/3 of a company, or if you take control of a company, for example, you have to make an offer for all the shares of the company, okay, not just for the 60%. So therefore, you cannot buy 60%, let's say, at a discount or at a negotiated price and not the others. So if I bought the 60% in a negotiated price, I have to make an offer for the outstanding remaining 40%, and I have to offer them the same price. Okay, so I cannot, and then those other 40% accept or do not accept, obviously. That's a different question. But I cannot have a lower price for the 60% than I have at the market price. So the question here refers a little bit more to company law. It's a little bit more complicated. Okay, so Chung Tran, you raised your hand. So you can turn on your mic if you want to and speak to us, or write your question in the chat. Either way. Chung, please. Or you just did this by accident. I don't know. Well, okay. Write something in the chat. Otherwise, I will continue. Okay, so that means here the 40%, I cannot do just a proportionate calculation. So I need to do a standalone calculation. What is the fair value of those 40%? That means I need the regular valuation techniques that I use. Okay, so in our example here, I tell you that the fair value of NCI has been valued at 70. Again, the 70 here is a random number. It's based on something else. It's not at all based on the accounting numbers of S. It's just a random number that I give you. Okay, because we did the valuation and it turned out it's 70. Okay, that means here to calculate my full goodwill. So I paid 120 for my 60%. The other 40%, they have been valued and they have a value of 70. Okay. So it means I have like a hypothetical total value of the company of 190, because I add the two values of 190. And what do I get for the 190? Obviously, I get 100% of the fair value of the subsidiary. So here, once again, we assume book value and fair value of the subsidiary are identical. Therefore, the fair value I get is 150. Okay, so that means I will deduct 150 because that is the fair value, total fair value of the subsidiary. That means I have 120 plus 70 is 190 minus 150 equals 40. So 40 would be the full goodwill. A goodwill calculated for 100% of the subsidiary. Obviously, you see that the partial goodwill will always be smaller than the full goodwill. Makes sense, huh? The partial goodwill is only for the parent company. The full goodwill is for 100%. Therefore, the full goodwill incorporates basically goodwill that relates to non-controlling interest. And therefore, it must be higher, and it's always higher. And here the difference is 10. And actually, later on, those additional 10 of goodwill, they relate to NCI, non-controlling interest, and therefore we will find those 10 in NCI, in non-controlling interest. Okay, let's see how this works when we use the full goodwill method. So we calculate the goodwill of 40. I still take 100% of the subsidiary numbers. Okay, it's the same thing. The only thing here, I change the order of integration, but it doesn't really matter. So I add the goodwill and put this in equity, and then I delete 120. And you see the remaining value here is 70, which equals the fair value of NCI. Because when I use the full goodwill method, I cannot calculate the NCI in a proportionate way anymore. Remember here, the NCI was simply 40% of equity. Here, it's not a percentage anymore. The first NCI value has to be the fair value that I have calculated. And the fair value was 70. Okay, so it's not a percentage. It's just the remaining value. Okay, which is my non-controlling interest. Okay, question so far? So let's compare the full goodwill balance sheet that we have here and the acquired goodwill balance sheet that we have here. What are the differences? Well, actually, there are only two differences. The first difference obviously relates to the amount of goodwill. Here in the acquired goodwill, I have a goodwill of 30. In the full goodwill method, I have a goodwill of 40. Okay, that's one difference. And if I have higher assets here of 10, there has to be a difference of 10 somewhere else. Where is it? Well, it's in NCI. Here the NCI are 70 in the full goodwill method. In the acquired goodwill method, NCI are only 10. So it means when I change, or when I compare the acquired goodwill method and the full goodwill method, well, the difference is in the amount of goodwill and the amount of NCI. Going from one to the other, that means I will add plus 10 in goodwill and I will add plus 10 in NCI. Or if I go from full goodwill back, it's minus 10 in goodwill and minus 10 in NCI. Okay. That's the choice between those two. So I can choose between a higher goodwill or a lower goodwill, and I can choose between higher equity or lower equity because non-controlling interests are part of equity. Now, the question is, why is there a choice in IFRS? Because we know that, one reason we do have IFRS is comparability. And obviously, when I incorporate accounting choices, that is bad for comparability because now I have some companies that use one method, other companies use the other. I don't even know in what proportions, and that hinders comparability. Okay, so why do we have the possibility between two methods? Well, actually, you see that in US accounting, the full goodwill method is the only method that is allowed. So in US GAAP, there is no choice, only full goodwill method. So IFRS wanted to do the same thing, require the full goodwill method only and leave alone the rest. But there was a lot of resistance of many countries, in particular out of the European Union. Traditionally, in traditional accounting, we only do the acquired goodwill method. So what is the main criticism of people who don't want to use the full goodwill method? Well, the main criticism is the fair value of NCI. Why? Well, because the criticism is to say that this number here, the 70 that I calculated, they are highly subjective because they are not based on a transaction. It's just a number on paper. There is no transaction. The only transaction is the 60% here. That's a transaction. So the 120 is a rather objective value. The 70 is very subjective. And that means obviously by manipulating the way how I calculate the fair value of NCI, having a higher value or lower value, at the same time I manipulate the amount of goodwill. Whereas here there is less manipulation. So that is the main criticism. And that's why, in particular in Europe, but not only, they insisted on having the choice between two methods. The idea of the IASB is to say, okay, I propose you two methods. And now, even in Europe, some companies sometimes use the full goodwill method. And the more you get used to that, the lower will be the resistance. And that means maybe in 10 years or so, we will get rid of the acquired goodwill method and we will apply only the full goodwill method. But as of now, companies have the choice between both of them. All right, that's the difference between acquired goodwill method and full goodwill method in case we take control of another company with a percentage that is lower than 100%. All right, any final question, please? If not, we are done for the day. Any final question? Well, doesn't seem to be the case. Then we are done for today. Well, thank you very much. And I see you tomorrow.